Welcome back and Happy New Year, everybody, to We Are TPM with myself, Kyle Teixeira, sitting next to this guy, John Teixeira, right here. We are back to discuss this week realizing your losses. If you want to give us a call about realizing any losses related to real estate, I guess I should specify, give us a call, 817-818-9039, and we can discuss how we're actually talking about not realizing your losses today. But or shoot us an email at showmethemoney@wearetpm.com. John, let's get into it. What are we talking about? Realizing your losses.
Well, I just realized as you were.
You realized?
No, yeah, very good. The pun was very that was not intended. But it just occurred to me that while you were introducing our topic, that's a really crappy and negative way to start the year, isn't it? Realizing your losses.
Well, I mean, a lot of people end the year realizing their losses.
Yeah, they're thinking about it,
depending on what what industry you're talking about.
Well, this is the topic because it's a real current topic, right? It's something people are feeling, dealing with. People are investors are dealing with the decision of whether they should, after a couple years of flattened rental rates and increased insurance and taxes, and it's just biting into their bottom line on a cash flow basis. So
you're jumping straight into it. Let's what does realizing your losses even mean?
Okay, go for it. You tell me. I know what it means. You tell me. Tell the people.
No, I'm trying to tell the people. So the people we're talking about, taking a step back, is that if you have losses in any investment, they're not realized until they're finalized. So if you have a stock that you bought and it's down, it's an unrealized loss. You haven't actually lost money until you sell it, right? That's pretty standard in investing in real estate. You haven't lost money.
Podcast over. Done. If you have any more questions, just call us.
Well, when is a good time to realize your losses and when isn't, right? That's a big thing that we want to discuss here, right?
Yeah.
So to keep it simple, like I mentioned stock, how many people realize their losses at the bottom of a stock going down?
Yeah, it's unfortunate. You see a lot of people do that. A lot of people freak out when the stock market starts crashing, and they freak out thinking it's going to crash more, and they again, like you said, they liquidate. That realizes your loss. You may have gone down more, but as long as you don't cash it out and liquidate it and you allow it to bounce back up and beyond where you were and where you want to be, then you didn't realize your loss and you let it come back, right?
Mm-hmm.
Like realizing it is basically liquidating it. I'm done. I have my money. Whether it's a gain or a loss, you're realizing it at the moment you liquidate it.
Well, and there's realizing losses is preferably, even if you have losses, right, or gains or whatever on an investment, you want the timing of it to be good. Not that you should time every market. Like timing buys is a lot different than timing sales, right?
Yeah.
In any investment, because you can. Timing buys is way harder and is way less advised. Well, timing sells is not as hard because you're already invested and you have a time horizon, so you can see trends and see things that happen. But why do so many people? I've actually been asked this question recently. Why does everybody feel like they sell at the bottom of an investment, right? Like at the bottom of a real estate market, everyone's like, "Oh, well, I sold at the bottom. I don't know how." Or a stock, I sold at the bottom. I don't know how. Well, what's the fundamental? What is a bottom? Like if you look at a stock chart, the bottom is where everybody jumped in and started buying. That's what you have to. That's a better way to look at it. It bottomed out because the buyers showed back up. The demand.
You're also talking right now. You're describing a stock market, a stock trade type of environment, which is way more volatile, changes by the minute, by the day, by the minute.
Yeah, well, I'm using it as an example for something that is over a longer time horizon. So what are we talking about? We're
real estate doesn't work quite that way. I mean, it does. The principles are the same, but the timelines, like you said, are way different, way slower.
Timelines. Principles are the same. So, and why are we talking about this right now? So we're currently in a market where a big portion of, let's talk about rental property. People who own rental property have year over year, so from the beginning of 2026 to the from the beginning of 2025, it feels like losses are starting to pile up as far as things increasing, right? You have taxes increasing, you have insurance increasing a ton, and we stopped getting the rental increases that we previously had to make up for all this stuff. And realizing those losses after a year can be a bad perspective, right? When do you define losses? Do we talk about the losses of the investment or the losses over the last year?
Well, that's kind of what I was getting at the beginning was investors are feeling it, right?
Mm-hmm.
For all those reasons. They're feeling it. Rental rates aren't going up like they used to. And so a lot of times when insurance and taxes go up, so do the rental rates. So it's kind of offset and it doesn't hurt so bad. But investors tend to be very short-sighted, right? And no matter what they're investing in. And sometimes they forget that the reason they got into the market was a long-term play. And so because they're short-sighted, they're looking at the amount of money they're either spending, losing, not making, whatever it is, on a short-term basis month after month, right? And for all those reasons that you described, that affects those numbers and makes that the investors feel that pain. If they have multiple properties, they're feeling that pain 2, 3, 4, 5, 10, 20 times over, right? Each time they look at one of their analytics and one of their properties, they're like, oh, that one sucks again. Oh, that sucks. And then so eventually you're just like, this market sucks. So maybe I should get out of this. And then all your water heaters go at one time,
Mm-hmm.
And then it's like, oh, now I got to replace, 4 water heaters and 2 AC units and
yeah, which should be looked at as an investment too, because if you just put in a 15-year AC and a 10-year water heater, and you just did those things, they're not just expenses on that year. They're supposed to be improvements that affect expenses going forward. So if you cut out that entire going forward part, then they were just an expense and an investment for someone else.
You make a great point. Can I state that a little bit?
Sure.
Because that's a super good point, Kyle. That's another way that people realize their losses. I had a house for, I'm just making this up. I have a house for 10 years. The AC goes out and I spend $6,000 on that house. And that year or the next year, I decide to sell that house because I'm losing my butt. Well, you just put a new AC unit in for the next owner. Thank you very much. Next owner is thanking you very much, right? Instead of, I lost some money having to put that $6,000 AC unit in. Let's hang on to it for another 10, 15, 20 years to recoup that loss, gain appreciation in the property, gain more cash flow down the road, because eventually it's not always going to be the way it is. The markets are always cyclical. And instead, I decided to sell because of these bad things that are happening, and I immediately realized that loss. Right? Of that AC unit. Well, I see people do that all the time.
And there's certain factors to real estate, and this is why, because they're bigger time horizons, the factors that show you bottoms and tops tend to be easier to see because you have more time to see them, right? So we essentially had a top of a market in 2023, right? And it's not that we've gone way down from that, but we definitely haven't gone up from it. Nobody's going to sit here and tell you that we've increased. Well, some mathematics will, but in the general market, that's where our kind of top was. And a lot of people sold there. Well, why did they sell there? Well, it's the natural way markets work, but we had really high bond returns, so yields on bonds, because interest rates were so low, but you could sell the real estate and go get 8% on bonds or something, something really high on yields, where we're at the opposite market right now. If you realize your loss at possibly another bottom, what are you going to do with that money? Well, I'll tell you one thing you're going to do with that money. You're going to pay capital gains on it because you sold. So say goodbye to 20 to 30% of that money in tax. And now what are you going to do with it? You're going to sit it in a CD that's making 2 to 3%. You're going to sit it in that's less than the appreciation on an asset after you just paid capital gains. Where are you going to park that money? Do you have something else? Are you going to put it in gold like everyone's doing right now? What's that plan? This isn't the market where the transition from a real estate asset into something else just makes a ton of sense. In 2023, there was people who sat on appreciation rates of 80% in 3 years, and they could go swap that for bonds for another 10 years that are making 6 to 8%. I mean, I know I'm throwing a lot of math out there, but it just those decisions made some sense. It made sense to realize gains in that scenario. Not that that's what we were advising, because it's still a long-term investment, but it definitely made more sense than right now. Right now, when the Fed is now doing the opposite and doing quantitative easing, where they're buying bonds. What kind of bonds? They're buying real estate bonds. In order for people to sell real estate bonds, what do they have to do? They have to put together a bunch of real estate into this bond, which means they have to buy real estate, which tells you the Fed is influencing, again, real estate being purchased by institutions. So these are all factors that are currently happening. At the top of 2023, the Fed changed everything and started quantitative tightening, where they are doing the opposite. They're influencing not buying assets. So, and in 3 to 6 months, the markets respond, and that's how it's gone. And I'm not just predicting, nobody's predicting, we're using historical things. These are what have happened in history that affects the real estate market. And because it goes slower, you can see these trends
or feel them longer while you're feeling the trends. Like, right? Like if your stock goes down and you got to wait 30 days for it to bounce back up,
yeah,
that's not so long. If you got to wait 3 years for your house rents to go back up,
and interest rates have gone back down too. Fed came out yesterday, said they're keeping rates steady, and that it's not basically, they say a lot of things, but they said they're keeping it steady, and the current rates are not restrictive, meaning they think everything's good. They don't think it's going one way or the other, or they may think a different thing, but that's what they said. So, so either that changes and stuff gets really bad and they cut rates more, or things stay good and they're influencing the purchasing of real estate again.
Okay, so high level, everything you're talking about, you're exactly right. And the person who wants to time the market, and they're being, I don't want to say this negatively, but short-sighted for some reason, right? Like they're thinking in a short-sighted manner for maybe some good reason why they're doing it. They're about to retire, they need to cash out for some reason, whatever. They need to be understanding all this that you're talking about, right? They need to be paying attention to this stuff if they have an understanding of it. But most people should have a long-term view of their real estate investments. And so I would say, what is your current goal for your real estate investments? Is it to hang on to them and die and leave them to your kids? Is it to use them for retirement, so you're going to cash them out when you're 65?
Mm-hmm.
Is it for your next stage of life, your next career? You're going to cash them out when you're done retiring from the fire department. Everyone starts with a goal. My thing is, keep your decisions with that goal, that end goal in mind, and stick with it.
Because timing's always going to matter.
Yeah. And then you don't have to worry about all the stuff you just talked about the last 10 minutes. You don't need to worry about any of that stuff until you're at that point of your goal where it's time to liquidate.
And I guess that's where I was getting is a lot of the outline factors we normally see at the bottom of a market. And it's like, well, we're not talking about long time horizons here, even though it is real estate. We're talking about you didn't sell a year ago. So if you didn't sell a year ago, maybe you should wait another year for you sell, because we're kind of in that figuring it out phase where.
Well, if you want an opinion as a real estate agent and property manager, I think we're at a point right now where things are going to start ramping up slowly, not aggressively, but they're going to slowly start ramping up again. Yeah. I don't believe rental rates are going to ramp up. But I do believe sales, the production of sales and sales prices are going to start increasing at a normal, healthy rate again.
Yeah, if you get affordability back to some degree, and and a lot of people don't talk about this because they don't understand it, but the dollar, well, what is being talked about a lot is the weakening of the dollar. The dollar is weakening. There's people getting scared that it's going to crash or whatever, and you don't even need to understand what that means. But if a weaker dollar means international people get cheaper real estate in America. So what do you think they do? They buy it up. That's what they did.
As long as Trump lets them buy it.
And he will let them do anything that increases the prices of real estate, which he's actually said. So, they're also giving $25,000 to first-time home buyers now. So is that smart? Mathematically? Economically? No. Is it good for home prices? If you own them, yes, because it will increase them. Because what happens? These are how markets work. If you give a first-time home buyer $25,000 on a $400,000 house, the price of that house is going to become $425,000. So
Eventually,
to keep it really simple.
You're not.
Eventually, in a stronger market, eventually is not very long. If you have 8 home buyers, all with $25,000, that's the dynamics. That's the market dynamics. So throwing money at the world has never. I don't know. It has consistently done the same thing. I'll say that.
I think what we wanted to bring to light with this podcast is just to make sure people recognize when they're making these decisions, why, for whatever reason they're making the decision, however they're making the decision, just to make them realize that especially if it's a long-term play, don't forget, as soon as you liquidate an investment, whether it's a house, a stock, a bond, whatever it is, something that goes up and down in value, as soon as you liquidate it, you're done. You are done at that point. If you have a gain or a loss, you have realized it, and you're now either going to pay capital gains on it, or you're going to take your loss, and you're never getting the opportunity for that to come back again. And that may be the smart move. I'm not saying it's always a bad move, and it depends on the situation. And again, we talked about people's goals, right? If I've got to retire next year and I don't think the market's going to get much better, why not sell now? If I need to sell my 5 rental houses so that I can move to Belize in May, which sounds amazing, huh? We should do that. Then I'm selling them. Even if I'm realizing a certain loss, I'm selling them because that was the purpose. In May of 2026, I'm headed to Belize. Let's go. It's not going to get worse. It's not going to get better between now and May. So just do it. My point is, keep your goal in mind and don't worry so much about all this stuff. Or if you worry about it too much, then you end up realizing losses too early, right? That's kind of what our point is. In a sense.
Yeah, and I mean, honestly, depending on your equity position, even if you're going to Belize, cash out refi them. You don't pay taxes on loans, man.
There are other ways to accomplish the same thing that you're trying to accomplish. Yes, but I think the point I'm just trying to make is we're watching a lot of people run scared and make bad decisions that we think are bad decisions. We don't know their situation or the other motivations for making them them want to do it. But
we see the different emotions in different markets. When the market's going good, there's, what else can I buy? What else can I buy? What else can I buy? This is awesome. What else can I buy? I'm like, well, probably not when you want to buy. You probably want to just rake in the money for when it comes time to buy again, like right now, like what everyone's doing. And I'm not, disinfluencing people buying in real estate at any point in time, but those are the emotions we see. When you get to the top, you see everybody wants to buy at the top of a market, and, it's the emotion. And then at the bottom, you see, everyone wants to sell. So
it's funny.
And then you get deals and deals and
I've
deals.
I've said this before. A good indicator of how the rental market is, or how the market is in general, believe it or not, is your wholesale off-market deals, which we're pretty in tune to. And it's funny because when things are going great, you almost can't buy one of those things without overpaying for it, because you show up and there's 25 investors out there and they need their bids in an hour, and they're overpaying for this house to a point where they're not going to make any money, right? And then you get to points like now, or in the recent past, where you're getting phone calls, text messages, and emails almost hourly from people trying to pawn off their wholesale deal on you. And then a month later, it's reduced the price, and they're still trying to get it. You know what I mean? Like we watch these things. We can see these off-market deals and
even
how
on-market ones these days.
Yeah, I mean,
because you got to get in front of the boat. It's like, when things are increasing, it's how you price something. Even if it's wrong, the market can catch up, right? Because it's increasing. Well, it works the same the other way. If you overprice something in a market going down, it's not catching up to you. It's leaving you behind. And then now you're chasing a fallen knife. You got to get ahead of that knife if you want to sell something, or that's why it looks like discounts, or you see rates of price cuts. It's because you're seeing people price things based on comparables in a higher market.
Is that a dull knife or a sharp knife? Is it going to cut you?
It's not really a knife.
It's going to fall on you?
It's just the price of your asset.
It was a great.
So, I mean, if you catch the price of your asset, that'd be good. Yeah.
If you catch the knife by the handle, then.
I mean, when a stock falls in like 10 minutes, they definitely call it a falling knife because
yeah,
it cuts some souls open. All right. Well, I think the point of this, and to summarize it, is realize what realizing your losses is about. Because that's what a lot of people don't. They just get frustrated with whatever they're seeing, whatever it may be, whatever the reason may be, and they just call it quits and all at once. Throw their hands up. So
yep, they just forget that they're realizing their losses.
Well, you're costing a lot of, just analyze it. You see how much you're costing yourself. If a refi and pulling some money out makes sense, and using some of that money to pay off your headaches, that can be an option. A lot of people say it doesn't make sense to take a loan to pay a loan. Well, sometimes it makes sense, especially if you're in a high income tax bracket where you're paying a higher capital gains. It's all math. It's all math that can hurt you, and I've seen it happen. And once you realize it, you can't go back. You can't go unsell that property and not pay. If you lost $3,000 last year and that pisses you off on the property after making 10, 20 a year before that, and you sell it and now you have an IRS bill for $30,000, it's not going to feel like a win the next year, and could increase your tax bracket too. I've seen that mistake happen to people where
I'm getting depressed listening to you.
Yeah.
Hey, taxes.
These are all things
losses. That happen. This is exactly the kind of emotion that investors feel, right?
Have you had some losses in the last year? Are we in?
Yeah, I've had some losses. Absolutely, everybody's had losses in the past year. Yeah. Absolutely. So keep your head up, persevere, keep going. Real estate is still the best investment that there is.
And, it's exciting. It seems like a good time to buy more.
Yep, it does. Right now, though, before too long. Hurry and do it soon.
When it's easier to get financing, they're writing loans, all that stuff. So, go get them done.
That's right.
Give us a call if you want to get done. 817-818-9039 if you want us to analyze, and so you can realize or not realize or remain unrealized. Shoot us an email. Show me the money at wearetpm.com. John and Kyle are out.
We gone.